Hey everyone, welcome back to Corporate Decoder. Today we are diving deep into Illumina's latest financial report. Get ready because this report is packed with some interesting moves and some numbers that might make you do a double take, especially when we look at how they are managing their finances after some pretty big business changes. And hey, if you dig getting the inside scoop on these corporate filings, be sure to smash that subscribe button and join our growing community on Discord. Link is in the description below. Illumina Incorporated, a company we know for its leading genetic sequencing and analysis tools, is showing us its financial performance for the third quarter of 2025. They operate in a space that's crucial for scientific research, medical diagnostics, and even agriculture. Think of them as the backbone for understanding DNA, which has massive implications for health and beyond. But even leaders face challenges, and Illumina is no exception. Let's first look at their financial health, their balance sheet. As of the 28th of September 2025, the company reported total assets of $677 million US. Now compare that to the 29th of December 2024, when it was $303 million US. That's a slight dip in total assets. On the flip side, their total liabilities and stockholders' equity also saw a decrease, bringing it to $677 million US from $303 million US. This indicates a slight shrinking of the company's overall size in terms of assets and the claims against them, including what shareholders own. Looking at their current assets, accounts receivable, which is money owed to them by customers, stands at $729 million US. This is a small decrease from $735 million US at the end of 2024, suggesting customers are paying up a bit faster, or perhaps sales were slightly lower, leading to less money outstanding. Inventory, which is their raw materials and finished products, increased from $547 million to $590 million US. This could mean they are building up stock in anticipation of future sales, or perhaps some items are not selling as quickly as planned. Now, let's check the liability side. Current liabilities, what they owe in the short term, jumped significantly from $547 million to $962 million US. A big part of this increase is the current portion of their term debt, which went from $499 million to $998 million US. This means a much larger chunk of their long-term borrowing is due within the next year. Their total term debt, including both short and long-term, also shows a significant jump. Total term debt went from $989 million to $992 million US. While the total amount is similar, a larger portion is now short-term. This signals a need for immediate refinancing or repayment. On the stockholders' equity side, which represents the owner's stake, we see an interesting picture. Their accumulated deficit, which is essentially a running total of losses over time, decreased significantly from a negative $242 million US to a still negative, but smaller, $726 million US. This is a very positive sign, meaning they are becoming profitable enough to start chipping away at past losses. Also, their treasury stock, which is stock they bought back from the market, increased from $934 million to $645 million US. This shows they have been actively buying back their own shares, which can be a strategy to return value to shareholders, or to offset dilution from stock compensation. Now, let's move to the income statement, where we see how much money they made and spent. For the 3 months ended the 28th of September 2025, total revenue was $0.84 million US, almost identical to the $0.80 million US in the same period last year. However, looking at the first 9 months of the year, revenue decreased to $384 million from $268 million US in 2024. This slight overall dip in revenue for the year so far might be due to some of the challenges they mentioned later. Product revenue, which comes from selling their instruments and consumables, remained pretty steady for the quarter at $927 million, up slightly from $914 million. For the 9-month period, product revenue was $719 million, virtually the same as $718 million last year. This stability in product sales is a good sign, showing resilience in their core business. But service and other revenue, which includes things like service contracts and genetic sequencing services, saw a decline. For the quarter, it dropped from $166 million to $157 million. And for the 9 months, it fell from $550 million to $465 million. This significant drop in service revenue is a key factor in the overall revenue decline for the year-to-date period. The report explains this is partly due to a decrease in revenue from strategic partnerships and also the spin-off of their Grail business. Digging into costs, the total cost of revenue for the quarter increased slightly to $351 million from $335 million. For the 9-month period, it went down to $1,073 million from $135 million. This decrease year over year is a positive sign, indicating they are managing their production costs more effectively. This brings us to gross profit, which is revenue minus the cost of revenue. For the quarter, it was $733 million, down slightly from $745 million. For the 9-month period, it nudged down to $111 million from $133 million. While not a huge drop, it means their profit from selling their products and services before other expenses stayed roughly the same or slightly decreased. Now let's look at operating expenses. Research and development, a crucial area for a tech-focused company like Illumina, saw a decrease. For the 3 months, it was $229 million, down from $253 million year to date. It dropped to $728 million from $930 million in 2024. This reduction might suggest a strategic shift or cost saving measures in their R&D spending. Selling general and administrative expenses, which cover marketing, sales, and overhead, actually increased. For the quarter, they went up from $239 million to $277 million. For the 9 months, they increased to $777 million from $621 million. This rise is partly attributed to changes in the valuation of their contingent consideration liabilities, which are basically payments they might have to make based on future performance of past acquisitions. The report mentions a significant gain in the prior year related to these liabilities, so the current increase looks less alarming when you consider that context. A really striking number here for the 9 months ended the 29th of September 2024, there was a massive goodwill and intangible impairment charge of $889 million. Impairment means they recognized that an asset, like goodwill from an acquisition or an intangible asset, had lost value. This charge from last year explains why their net loss was so substantial for that period. In contrast, for the same period in 2025, there was zero such impairment, which is a strong indicator of improved asset valuation or a less challenging acquisition environment. Interestingly, the legal contingency and settlement line item shows a credit of $488 million for Q3 2024 and $474 million for the 9 months, ended the 29th of September 2024. This indicates a favorable resolution or a reversal of a previously recorded liability. It turns out this was related to the withdrawal of a fine by the European Commission regarding the Grail acquisition, which is a positive development. As a result of these changes, income from operations for the quarter was $227 million, a drop from $741 million in Q3 2024. However, the 9-month operating income swung from a significant loss of $108 million last year to a positive $606 million this year. This is a massive improvement, largely driven by the absence of those huge impairment charges and the legal settlement gains from the prior year. Other income and expenses also play a role. For the quarter, it was a net gain of $9 million compared to a net expense of $21 million a year ago. This improvement is mainly due to better performance from their strategic investments. For the 9 months, it was a gain of $103 million compared to a substantial expense of $358 million last year, largely thanks to positive investment results and the absence of a significant loss on their retained Grail investment from the previous year. All of this leads to the bottom line, net income. For the quarter ended the 28th of September 2025, net income was $150 million. This is lower than the $705 million in the same quarter last year. However, for the 9 months, they reported a net income of $516 million, a huge turnaround from a net loss of $410 million in the same period of 2024. This switch from a massive loss to a profit over the first 9 months is perhaps the most significant financial story in this report. Diluted earnings per share reflects this profitability. For the quarter, it was $0.98 per S-share, down from $4.42 per S-share last year, but year-to-date diluted earnings per S-share turned positive at $3.29. A dramatic shift from a loss of $8.86 per S-share in the prior year. Looking at comprehensive income, which includes unrealized gains and losses on things like currency hedges, the picture is similar. Net income for the quarter was $150 million, and total comprehensive income was $159 million for the 9 months. Net income was $516 million, and comprehensive income was $482 million, which reflects some unrealized losses on hedges. The statements of stockholders' equity show how the owner's stake has changed. The company's common stock and additional paid-in capital have seen increases, reflecting share issuances. However, treasury stock, the shares bought back, has also increased significantly, indicating a strong share repurchase program. The accumulated deficit is shrinking, And the overall stockholders' equity, while fluctuating, shows a net positive progression over the periods presented after the massive loss in the prior year. Let's look at the cash flow statement, which shows the actual cash moving in and out. For the first 9 months of 2025, net cash provided by operating activities was $758 million. This is a healthy increase from $473 million in the same period of 2024. This means the company is generating more actual cash from its core operations, which is a key indicator of financial health. Investing activities show a use of cash. For the 9 months, they spent $163 million on investing activities, mainly for property and equipment. This is a bit more than the $130 million spent in the same period last year. This suggests continued investment in their infrastructure and operations. Financing activities show a significant use of cash. In the first 9 months of 2025, they used $681 million for financing activities, largely driven by $700 million spent on repurchasing their own common stock. This aggressive share buyback program is a major reason for the outflow of cash. In 2024, financing activities also showed a significant outflow, partly due to the spin-off of Grail, which deconsolidated $968 million of Grail's cash. Illumina explains that they are a leader in genetic analysis. A major event they mention is the spin-off of Grail in June 2024. They distributed most of their shares in Grail to Illumina shareholders, retaining a smaller stake. This spin-off did not qualify as a discontinued operation, meaning Grail's past financial results were not reclassified. They also contributed $974 million to Grail to help fund its operations for 2.5 years. This spin-off is a significant strategic move, allowing Illumina to focus on its core genetics business. Looking ahead, Illumina has a pending acquisition of SomaLogic Incorporated for $350 million in cash. They believe this deal will strengthen their position in the growing proteomics market and enhance their multi-omics strategy. This acquisition is expected to close in the first half of 2026 and is subject to regulatory approvals. The report breaks down revenue by product and service. Product revenue is stable, with consumables showing steady growth and instruments revenue seeing some fluctuations impacted by customer purchasing behavior and instrument shipments. Service revenue has seen a decline, partly due to fewer strategic partnerships and also the Grail spin-off. Regionally, Americas and Europe show steady performance. However, revenue from Greater China has seen a significant decrease. The company mentions being added to an unreliable entities list by Chinese regulatory authorities and being prohibited from exporting sequencing instruments into China. This is a serious challenge that will likely impact their future performance in that key market. Their investments include marketable equity securities, primarily their retained stake in Grail, which is valued at $228 million. They also invest in venture capital funds, which are accounted for differently. They are taking on commitments to these funds for many years into the future. A fascinating part of the report is the discussion around contingent consideration liabilities. These are essentially future payments tied to the performance of past acquisitions. The report details their Grail contingent value rights, which give holders a percentage of Grail's future revenues. The fair value of these liabilities is estimated using complex models and assumptions. And the company acknowledges that small changes in these assumptions can have a big impact on the liability's value. This highlights the uncertainty and judgment involved in valuing these types of financial instruments. Illumina has term debt obligations totaling almost $2 billion. Notably, a large portion of this debt, almost $1 billion, is now due within the next year. As seen on their balance sheet, they also have a $750 million revolving credit facility, which is an undrawn line of credit they can use if needed. The covenants on this debt require them to maintain specific debt to EBITDA ratios, showing a focus on managing their leverage. Shareholders' equity reflects the company's financial performance and capital management. Illumina has been actively repurchasing its own stock, with a significant authorization of $1.5 billion for buybacks. This, along with share-based compensation, impacts the equity structure. The company continues to issue shares under its stock plans and employee purchase programs. The share repurchase program is a major theme. The company has actively bought back shares, spending $706 million year to date in 2025. This indicates a strategy to reduce the number of outstanding shares, potentially boosting earnings per share. Under supplemental details, we see their allowance for credit losses on accounts receivable is very small, a good sign that they expect most of their customers to pay up. Inventory levels have increased, as mentioned before, possibly indicating a strategic build-up. Illumina is involved in several legal matters. There are shareholder derivative lawsuits alleging breaches of fiduciary duty related to the Grail acquisition. They are also facing securities class action lawsuits, claiming misleading statements were made about the Grail deal. The company is vigorously defending itself and notes that the outcome of these lawsuits is unpredictable, but could materially impact their business. The company also notes a books and records inspection requested by a shareholder and litigated. Their income tax rate has seen significant shifts for Q3 and year. To date 2025, the effective tax rate was higher compared to 2024. The report explains this is partly due to new US tax legislation affecting research and development expenses and the recording of a valuation allowance for deferred tax assets. They also highlight the benefit of earning income in lower tax jurisdictions like Singapore. As of this report, Illumina has one reportable segment, Core Illumina. The Grail segment is no longer reported separately following the spin-off. This simplification reflects a strategic move to focus on their core genetics business. Revenue and expenses are broken down by segment for comparability, though Grail's historical contribution is noted. Now, let's move to management's perspective. They highlight ongoing macroeconomic challenges like tariffs, inflation, and economic downturn concerns, which are affecting both Illumina and its customers. The situation in China with the unreliable entities list and export restrictions is noted as a significant risk. Management emphasizes their commitment to innovation and their leadership in genetic sequencing. The spin-off of Grail is presented as a strategic move to focus on their core business. The acquisition of SomaLogic is seen as a key step to expand into proteomics. They are also focusing on operational excellence and cost saving initiatives. The results of operations section details revenue trends. While product revenue is steady, service revenue has declined, impacting overall year-to-date performance. The company mentions the impact of tariffs and the situation in China on their sales. Gross margins have been affected by these factors, as well as by an intangible asset impairment. R&D expenses have decreased, while SG&A expenses have increased, partly due to accounting for contingent liabilities. The absence of goodwill and intangible impairments from the prior year significantly improves the operating income. Legal settlements and favorable resolutions have also positively impacted reported results. Changes in investment valuations and foreign currency movements are impacting other income and expenses. The company notes gains on strategic investments, a positive sign of their diversified holdings. The effective tax rate has seen significant adjustments influenced by tax legislation changes and the recording of a valuation allowance. This shows the complexity of managing taxes across different jurisdictions. Illumina's liquidity appears sufficient for the near term. They have cash and cash equivalents totaling over $1 billion, with a significant portion held internationally. Their primary sources of liquidity are operating cash flows and the ability to draw on their credit facility. The cash flow summary shows strong positive cash flow from operations, a significant improvement over the prior year. Investing activities show continued capital expenditures, while financing activities are heavily impacted by share repurchases. Management stresses that their financial statements rely on estimates and assumptions. They are closely monitoring the impact of tariffs, changes in government funding, and global economic factors. They state there have been no material changes to their critical accounting policies. Illumina is implementing an ERP system upgrade, which is a major project expected to improve financial information flow and reporting. This implementation may affect internal controls, and the company will monitor these changes. They conclude that their disclosure controls and procedures are effective. The report points to significant risks, including those related to the situation in China, reductions in IH funding, and trade tensions. These factors could materially affect their business. The company has been actively repurchasing its own stock under a $1.5 billion program, which shows a commitment to returning capital to shareholders. And after digging through all these numbers and details, here is my take. Illumina is clearly navigating a complex business environment. They've made some very strategic moves, like spinning off Grail and pursuing the SomaLogic acquisition, aiming to sharpen their focus and expand into new markets like proteomics. The return to profitability and strong cash generation from operations are definite positives, showing their core business is resilient. However, the revenue dip year to date, particularly the decline in service revenue and the significant challenges in the Greater China market, are areas that need very close watching. The increased short-term debt also warrants attention. Though their available credit suggests they have liquidity, the ongoing legal battles add another layer of uncertainty. Overall, Illumina is in a rebuilding phase. Shedding distractions to focus on growth, but the path forward still has its hurdles, especially with geopolitical and market uncertainties. What do you all think about Illumina's performance and their strategic direction? Is the focus on core genomics and expansion into proteomics the right move given the challenges, especially in China? Let me know your thoughts in the comments below. If you found this deep dive valuable, give us a thumbs up, and most importantly, make sure you are subscribed to Corporate Decoder for more of these unfiltered financial analyses. Don't forget to join our Discord community. The link is in the description. Thanks for watching, and we will see you in the next video.